Okay, let's unpack this. We've got the latest edition of FinanceX magazine, issue 13, in front of us, and it is absolutely packed with insights into the massive forces reshaping finance right now.
Yeah, quite a bit in here. This deep dive is really all about exploring what the magazine is calling beyond banking.
Right.
Looking at, the rapid rise of sustainable finance and digging into the crucial role technology, especially AI, is playing in, well, all of it.
Think of this as your shortcut, maybe, to understanding how financial services are sort of embedding themselves into our everyday lives. How sustainability has gone from maybe a niche concern to a core strategy.
Definitely.
And what some, frankly, incredible tech advancements mean for the future. Our mission is simple. Extract the most important nuggets of knowledge and insight from these pages, just for you.
Let's get into it.
All right, diving straight in, the magazine points out a really big challenge in today's global economy. Just the sheer amount of information out there.
Information overload, yeah.
Especially when it comes to something like sustainability data. It's fragmented, it's messy, and there's this critical need for what they call a common language.
And this is really where the Legal Entity Identifier, or LEI, comes into the picture.
Okay.
It emerged from the chaos after the 2008 financial crisis, specifically to create a unified and global framework for identifying who's who in financial transactions.
Right. Initially for transparency in markets like derivatives reporting.
Exactly. That was the initial push.
But it's really gone way beyond just finance now, hasn't it?
Absolutely. Its industry agnostic nature was kind of key. It's expanded to cross-border payments, global value chains.
Okay.
And crucially, it's now being applied directly to sustainability reporting and ESG frameworks. The magazine calls it a global data linchpin.
Okay, data linchpin.
Right.
What does that really mean in practice?
Well, it means it can effectively link up all these different disconnected data sources across industries. Think about climate-related data. The NGFS is quoted, highlighting how crucial the LEI is for ensuring that data is high quality, consistent, and actually comparable.
So you can compare apples to apples.
Precisely. Without it, you're comparing apples to, well, something entirely different. It makes meaningful comparison possible.
And they mention a concrete example happening in Europe.
Yes, the European Single Access Point, or ESB. This is an upcoming EU-wide platform for financial and sustainability data. And it's leveraging the LEI specifically to validate metadata. This helps reduce costs and administrative burdens significantly because you have this trusted way to identify the reporting entity.
They also call the LEI a global passport for supply chains. How does that work?
It's a great analogy, actually. It enhances transparency not just by identifying the main organization, but also by revealing the business relationships between them.
Ah, the ownership structure.
Exactly. That's the level 2 data, answering the who owns whom question. This level of granularity is becoming essential, especially for companies trying to analyze their Scope 3 emissions.
Right, those tricky indirect ones.
Which are all those indirect emissions throughout their value chain. Getting a handle on that is huge.
And it's not just about reporting, right? The article says it helps with risk.
Exactly. That transparency improves risk assessment and operational resilience. The magazine notes it's being incorporated into frameworks like FIRE and DORA, which are all about financial and operational resilience for institutions. So it feeds into stability, too.
So it's foundational for stable financial systems and transparent supply chains. What about digital-first stuff like carbon markets?
Yeah, the LEI and its newer verifiable counterpart, the VLEI, are seen as critical enablers for digital-first solutions.
Okay.
Especially in emerging areas like voluntary carbon markets, or VCMs. A global digital finance report is cited, highlighting how VCMs face challenges with integrity and accountability. The LEI and VLEI help by enabling reliable identification of participants, who issued the credit, who is trading it, who is buying it.
So it tackles things like double counting.
Exactly. Mitigating problems like double counting or greenwashing. It builds trust in those markets.
So it seems the LEI and VLEI are really becoming foundational for trusted data, especially in the context of sustainability reporting and the integrity of these new digital markets. Why should you care about entity identification, something that sounds maybe a little abstract?
Well, it's fundamental to navigating complexity today. Whether you're investing, doing business globally, or just trying to understand a company's environmental claims.
Right.
Knowing who is who and who owns whom is the bedrock. It's how visibility into those often opaque supply chains is enhanced.
And ultimately, how you can place more trust in the claims companies are making about sustainability or anything else.
Precisely. It's about building that trusted foundation.
Okay, building on that need for data, the sources tackle a particularly tricky challenge: measuring a company's environmental footprint, especially for small and medium-sized businesses.
Yes, SMEs. They're absolutely the backbone of the economy, but tracking emissions has been incredibly difficult for them.
Yeah, traditional methods sound complex and expensive.
They have been, and that's created a big data gap. But the magazine introduces something fascinating called GHG nowcasting from Mode Finance.
GHG nowcasting.
Yeah. It's this innovative approach that uses an AI algorithm to analyze information already present in a company's systems. And the surprising data source, purchase invoices.
Wait, analyzing invoices to estimate emissions? That's really clever. How does that even work?
That's the beauty of it, apparently. By analyzing the data within purchase invoices, what a company buys, from whom, how much the AI can estimate Scope 1, Scope 2, and even Scope 3 emissions in near real time.
Wow.
It's designed as a simple automated process, and the article mentions it's already been validated on a large sample of Italian companies.
So what's the practical impact for an SME actually using a tool like this? What changes for them?
Well, it makes emissions tracking accessible and credible for them, maybe for the first time.
Okay.
This significantly improves their transparency, whether that's with customers who increasingly demand it or investors looking at ESG performance.
And strategically?
It also creates strategic opportunities, potentially better access to credit, an enhanced reputation, and perhaps most importantly, it helps the company itself identify where their biggest emission sources are.
So they can actually do something about them.
Exactly. So they can actually work on reducing them effectively.
And from a bigger picture, a systemic view, what does this do for the wider economy?
It starts to bridge that huge information gap we have on SME emissions. This gives policymakers a much more complete picture when trying to define effective CO2 reduction policies.
Right.
And monitor progress towards big goals like the European Green Deal.
Yeah.
The article suggests this kind of tool helps transform sustainability for SMEs from, a complex, burdensome obligation into a real strategic asset.
So whether it's a global standard like the LEI for identifying who's reporting what, or an accessible tool like this GHG nowcasting, turning invoices into emission estimates, getting that foundational data right is clearly absolutely key to navigating the whole sustainability landscape.
Couldn't agree more. Data is the starting point.
Moving on, the core theme of the magazine is this idea of beyond banking. What does that phrase really mean for how financial services are going to be delivered in the future?
It describes a pretty fundamental shift, actually. It's moving from banking as a destination, where you physically go to a bank or log into a specific banking app to do finance things.
The old way.
To banking as infrastructure. Embedded finance and open banking are presented as the new rails that power everyday life by integrating those financial services directly into the platforms you're already using.
Can you give us a concrete example of what that looks like? Because infrastructure can sound a bit abstract.
Sure. India's BFSI sector, that's banking, financial services, and insurance, provide some really clear instances. The magazine points to Amazon's collaboration with ICICI Bank, allowing users to open savings accounts or access credit right within the Amazon app. You don't leave Amazon.
Okay. Seamless.
Or healthcare startups, embedding credit options directly at the clinic for customers to pay for treatments. In EMIs, they named CarePay, DigiSparsh, and Savin as examples.
Well, they're at the point of need.
Exactly. And platforms like CashFree and YAP are also highlighted for enabling consent-led open banking, allowing for personalized financial products that pop up when and where you need them based on your data.
So finance is becoming almost invisible in a way, integrated seamlessly into where you're already living and working.
That's the core idea, yeah.
The magazine also talks about banks expanding into entirely new service areas, specifically related to the energy transition.
Absolutely. The energy transition isn't just about banks financing massive solar farms or wind projects, although that's obviously happening.
Right.
The magazine suggests there are significant opportunities for them to become active participants in smaller-scale distributed energy. They could develop platforms for things like, say, solar panel sharing among neighbors, or financing green bonds for local projects, or enabling infrastructure for electric vehicles like charging networks.
And why is this expansion into energy significant for traditional banks? Why should they bother?
Well, it directly addresses the growing demand from climate-conscious consumers who need practical support for making green choices.
Like buying an EV or putting solar on the roof?
Exactly. Things like buying an EV, installing solar, doing energy-efficient home renovations. By helping customers navigate these complex decisions and transactions, banks can position themselves not just as financial providers, but as life partners, building really deep long-term loyalty.
And it's competitive, too.
Very. The magazine highlights that first movers in this space will gain a competitive edge against tech firms and even energy companies that are also entering this arena. They mention IREX Consulting specifically working with financial players on bridging the operational energy world with digital transformation, helping them figure out innovative business cases. Like, what's the actual value of energy flexibility for someone charging their EV at home? Banks could help manage that.
Okay, so banking is getting embedded into platforms and expanding into new sectors like energy. How does this broader trend relate to how businesses themselves build their teams and get work done globally? The magazine tackles different shoring models.
Yeah, there's definitely a lot of jargon and sometimes confusion around terms like offshore, nearshore, onshore.
It gets confusing fast.
It does. The article aims to cut through that noise by focusing on what they call right shoring.
Right shoring. Is that just a fancier word for outsourcing? Or is there more to it?
They argue it's much more deliberate. It's a flexible approach focused purely on finding the right skills in the right place at the right time. It's not fundamentally about where the talent is physically, but who has the expertise you need. This means a right shoring model could easily be a mix of onshore, nearshore, and offshore resources.
Depending on the need.
Depending entirely on the specific business need, whether that's time zone alignment for collaboration, cost optimization for certain tasks, or accessing really neat expertise. Gartner data is mentioned showing a trend towards product-centric delivery models that prioritize desired outcomes over simply where the team is located.
So it's definitely not just about finding the cheapest option then.
Exactly. That's myth 4. They debunk that cost per hour is the full picture. Time zone delays can kill productivity. Language barriers or slower decision-making with distant offshore teams might mean a slightly higher cost for a nearshore or even co-located model.
Right.
Actually delivers much better value through smoother workflows and faster iteration cycles. Deloitte data is referenced showing how blended teams can really improve agility and speed.
Is this only something big corporations can do? Or can smaller companies use this approach?
Not at all. That's myth 3 they tackle, that it's just for large enterprises. Scale-ups, in fact, can often benefit the most by tapping into experienced global talent early on.
How so?
This allows them to scale much faster without the significant risks and overheads associated with rapid hiring entirely within their, say, expensive home market. They give a specific, compelling example. A digital mental health scale-up operating across Spain, the UK, and the USA.
Okay.
This company used a tailored right-shoring model, working with teams in Portugal and South Africa via a company called BBD Software Solutions. This allowed them to completely re-architect their platform and scale flexibly across those different time zones.
And they added more locations later.
Yeah, later adding hubs in India and Brazil as they grew. It's a flexible, scalable model.
And it sounds like every business needs its own unique approach. There's no single right way.
Absolutely. The idea of a one-size-fits-all delivery model is myth 5 they debunk. Delivery models must be tailored to the specific project goals, the dynamics of the existing team, and the capabilities you need.
Yeah.
That scale-up example really shows this. The BBD team adapted their approach entirely to the client's specific needs, bringing enterprise-level thinking, cloud expertise, and agile practices that the scale-up might not have had in-house at that stage.
And the talent is there.
Yes. Myth 7 is debunked too, the idea that nearshore regions lack experience. They point out that regions like South Africa and Portugal have highly experienced engineers with strong enterprise backgrounds.
So whether it's banking services getting embedded or businesses strategically structuring their global teams, it's all about smart strategic choices in delivery and leveraging talent. Why should you listening understand these different shoring models?
Well, because it gives you insight into how the digital services and platforms you use every day are actually being built.
Okay.
It helps you understand the dynamics of the global talent market, which is increasingly relevant to many industries, not just tech. And it highlights key strategies for operational efficiency and scaling that apply to any business trying to grow and compete today. It's about understanding how work gets done globally now.
Let's shift gears a bit and look at the technology backbone supporting all this. The sources offer a really sharp take on how technology is used, particularly focusing on wealth management.
Mm-hmm.
Their core argument is that how you use the tech matters much, much more than simply what tech you use.
Yes, drawing on insights from someone named Matt Beecher, the article says the key challenge isn't having the latest flashy features, but achieving a tangible impact and seamless integration.
Right.
Advisors, and frankly many businesses, often fall into what's called a piecemeal technology trap. They just keep accumulating disconnected tools.
Building those Frankenstacks.
Exactly, building what the article calls Frankenstacks that end up creating more complexity and frustration than they actually add value.
So the real power comes from connecting everything, making it work together.
Precisely. Strategic technology adoption isn't just about solving one small pain point. It's about addressing holistic business challenges by creating a cohesive technological ecosystem. They give a great, simple example. A basic scheduling tool solves one problem, scheduling. But a higher value solution includes AI assistance for taking notes during the meeting and seamlessly integrates with your CRM.
So it updates the client record automatically.
Exactly, to automatically add contact records and tasks based on the conversation. That's integrated value.
That context advantage they mentioned sounds incredibly powerful.
It really is. Integrated tools leverage the full context of your business data. The magazine highlights solutions like Knapsack, which they say integrates with CRMs, SharePoint, OneDrive, Google Docs, and financial planning tools.
So it pulls everything together.
Right. This creates a truly comprehensive view of client relationships, allows you to synthesize information much more effectively, automate workflows, and ultimately significantly enhance productivity far beyond what any standalone tool could do. This trend towards deeply integrated context-aware technology is shaping the future of many industries globally.
And speaking of reshaping the future, the sources use incredibly strong language to describe the current pace of technological change. They call it nothing short of an artificial intelligence revolution.
Yeah, the language is striking. The article emphasizes that the pace of advancement since ChatGPT burst onto the scene in late 2022 has been, well, relentless. Models like Grok 3, GPT-4o, DeepSeek R1, they're evolving exponentially. The key phrase they use is that intelligence is effectively doubling every 6 months as the computing costs required keep dropping dramatically.
Doubling every 6 months. Wow. And it's framed as this intense global competition.
Absolutely. They describe a full-scale competition happening between nations and major corporations. They mention initiatives like the U.S. Stargate project, apparently valued at $500 billion.
Huge numbers.
And China's DeepSeek initiative. The sources call it a prisoner's dilemma scenario.
How so?
Well, no one trusts the other side to slow down or stop developing AI, so everyone feels compelled to accelerate as fast as possible, fearing they'll be left behind.
What's considered the biggest recent breakthrough discussed in the article? What's really changing the game?
They point specifically to AI reasoning. This new generation of AI systems is moving beyond just giving instant pattern-matched responses.
Okay.
They can actually take time to analyze, break down complex problems, and structure their reasoning step by step, much like humans do.
So it's thinking in a way.
The article states this makes AI an intelligent system capable of deep understanding. This capability is what they believe is leading to the replacement of labor with capital on an unprecedented scale and transforming industries incredibly quickly.
The launch of DeepSeek R1 in early 2025 is described as a shockwave in the article.
Yes, it's painted as a Sputnik moment for the U.S.
Right.
It seemingly demonstrated that China was much closer to parity in advanced AI development than many in the U.S. had perhaps assumed. The pattern they describe is the U.S. often innovating the breakthroughs, and then China rapidly replicating and industrializing them much cheaper, potentially making this powerful AI far more accessible globally much faster.
And NVIDIA's role in all of this, they make the chips, right?
Well, there's obviously debate, but the article makes the strong argument that NVIDIA is far more than just a chip manufacturer.
Okay.
They see NVIDIA as essentially owning the entire AI ecosystem, from the hardware to the crucial software layers like CUDA. Given that this new reasoning-based AI demands significantly more raw computing power,
Right.
NVIDIA's position remains critical, provided, of course, they can keep pushing the performance limits of their hardware.
Are we talking about artificial general intelligence here, human-level AI? Is the magazine saying we're close?
The perspective presented is quite striking, actually. They argue we are already there, or at least extremely close.
Really?
The most pivotal point they make is that AI is now seemingly driving its own progress. It's learning from and improving itself using synthetic data generated by other AI.
Oh.
This self-improving cycle, they suggest, means development is no longer entirely in human hands, which changes absolutely everything about the future trajectory.
That self-improvement idea is both fascinating and honestly a little daunting. So what are the potential benefits of AI highlighted in the article?
Oh, its transformative potential is described as immense. In healthcare, for instance, AlphaFold's work on protein structure is called revolutionary,
Yeah, I've heard about that.
potentially accelerating drug discovery beyond imagination and even enabling personalized medicine and extending human longevity.
Amazing possibilities.
Beyond healthcare, they suggest AI can democratize knowledge globally, help reduce poverty by boosting efficiency, provide access to education in underserved areas, and offer solutions like humanoid robots for elder care in aging societies. It's seen as a fundamental transformation with the potential for incredible good.
But the sources are also clear that there are significant risks too, right?
Absolutely. Huge risks. The risk of widespread job replacement raises massive questions about the future of work and how people find meaning if traditional jobs disappear. Geopolitically, the article points out the significant danger that AI could become a powerful tool for authoritarian control if it falls into the wrong hands or is developed without robust checks and balances.
A serious concern.
Which is why they stress that investments are needed not just in the technology itself, but critically in ensuring AI aligns with democratic values and ethical principles globally. That alignment piece is key.
So technology is becoming deeply integrated. AI is accelerating globally with both massive potential and significant risks. And the magazine argues that how we strategically leverage these tools is absolutely key. Why should you pay this much attention to this AI revolution?
Well, frankly, because it's going to impact literally everything.
Yeah.
It will affect your job, how businesses you invest in operate, potentially even your daily life in ways we can't fully predict yet. It's arguably the biggest driver of technological disruption we've ever seen, and understanding it, even at a high level, is crucial for navigating the coming years.
Let's pivot back then to sustainable finance and ESG, but with a rather unique angle the magazine takes. They draw this really interesting parallel between the journey banking is on with sustainability and the intellectual work of John Nash.
The beautiful mind mathematician.
Exactly, John Nash.
Yeah.
What's the comparison they're making there?
It's an intriguing connection. The comparison is that tackling sustainability effectively requires a similar kind of thinking that Nash pioneered: systems thinking, unconventional insight, and a real willingness to challenge established norms.
Right.
Much like Nash revolutionized game theory. A banking scene white paper, based on sessions in the Netherlands and Belgium, is highlighted, outlining these specific challenges for the financial sector through this lens.
So how does Nash's famous idea of cooperative equilibrium apply to banks and sustainability? Because banks compete fiercely.
Right. But Nash showed that the best outcomes, the most stable and beneficial results for the system, often come not from purely self-interested competition, but from working towards collective benefit. The article argues that for banks, sustainability isn't a zero-sum game where one bank loses by being greener. True long-term resilience and value come from strategic collaboration.
Collaboration between competitors.
Yes. Banks need to cooperate, even with competitors, to establish sector-wide and even society-wide ESG data standards and align all the overlapping reporting frameworks. They actually call this the Nash equilibrium applied to finance.
Just like Nash saw patterns others missed in games, the sources are saying banks need to make sense of the current ESG data chaos.
Exactly. The article talks about the ESG data dilemma. There's tons of data being produced, but huge issues with quality and comparability because of all these overlapping regulations and inconsistencies.
It's a mess.
It can be. So just as Nash created a new logic to understand interactive systems, ESG leaders within banks need to completely redefine how they do risk assessment. They need to integrate forward-looking climate models, scenario analysis, and this concept of double materiality. Understanding both the financial risks to the business from climate change and the business's impact on the climate and society.
Okay, two sides of the coin.
Exactly. They argue this requires an alliance of the willing within the sector to actually implement, which is a big shift for an industry historically focused on backward-looking financial data. A shared sustainability ontology, essentially that common language we talked about earlier, is crucial here.
And banks need a kind of intellectual courage to change their internal culture, like Nash persevering through skepticism.
Yes, they use the phrase culture trumps compliance. Sustainability can't just be a box-ticking compliance exercise. It has to be embedded deeply within the bank's culture.
How does that happen?
It needs to influence how they talk to clients, how board members are evaluated, even performance metrics for staff across the board. This shift from simply reacting to regulations to proactively building a sustainable vision requires significant courage, mirroring Nash's belief in the long-term equilibrium over immediate, potentially suboptimal gains.
So the message isn't just about avoiding risk or regulatory fines, but about actively creating value, finding opportunity in sustainability.
That's a really strong insight from the sources, yeah. Sustainability isn't just a risk mitigation exercise. It must evolve into a value creation engine for banks.
Okay.
This means actively supporting clients in their own green transitions and investing heavily in ESG literacy across the organization, from the front line to the board. The article argues that forward-looking risk management, particularly climate risk, is inseparable from deep client engagement and understanding their needs. A beautiful mind in banking, they suggest, is one that helps clients anticipate and adapt to this changing world.
It's a powerful conclusion. Banks need their own Nash moments, embracing systems logic, seeing these previously unseen patterns, making sustainability the central path to future growth, potentially even rewriting the rules of the game in finance through collaboration.
A challenging but potentially rewarding path. Shifting focus slightly, the magazine also analyzes some really recent European regulatory shifts, specifically the EU 2025 Omnibus I package.
Okay, the Omnibus package.
They see this as a strategic recalibration of key existing ESG directives like the taxonomy, CSRD, and CSDDD, impacting financial institutions and businesses across Europe.
What does this recalibration actually mean in practice? Less reporting. More.
Well, according to the article, it signals a shift away from prioritizing the sheer volume of ESG reporting towards demanding clear, tailored ESG actions.
Action over just words.
Kind of. Now, the package has faced criticism for potentially reducing mandatory disclosures and thus overall transparency.
Right, I've heard that.
But the magazine also presents it as potentially a pragmatic move towards manageable compliance and, importantly, an opportunity for strategic integration of ESG into core business. The Romanian context is mentioned as an example where companies, perhaps with greater flexibility under this recalibration, are proactively embedding ESG into their operations rather than just reporting on it after the fact.
Okay, so what are the specific key shifts this package introduces that the article highlights?
They point out four major ones. First, the rise of contractual ESG. This is a big one.
Contractual ESG.
Yes. Enforcement of ESG principles is shifting from just regulators imposing fines to becoming embedded in private contracts. We're seeing ESG representations, warranties, covenants, KPIs, and even default clauses being built directly into financial transactions and commercial agreements.
So it hits the bottom line directly.
Exactly. It's directly influencing deal structures and pricing. For fintechs, this means their ESG credentials can directly affect their access to finance and their partnerships as these obligations become legally enforceable terms of business. Having auditable ESG credentials gives you a competitive edge.
Okay, what's the second one?
Second, ESG and digital identity. Because there are reduced mandatory disclosures for some entities, especially smaller ones, there's a growing demand for secure, verifiable ESG credentials.
Like the VLEI we talked about earlier.
Potentially related, yeah. This is seen as a significant opportunity for fintech product innovation, thinking about how to embed ESG data and checks directly into KYC processes, onboarding flows, and risk scoring. They note integrated scoring tools could help banks direct capital towards companies clearly on green pathways, though they caution this has legal nuances that need careful consideration.
Got it.
Third, a focus on direct due diligence. The scope of the CSDDD, the Corporate Sustainability Due Diligence Directive, seems to be narrowing its focus, at least initially, to a company's direct business partners and borrowers.
Not the whole supply chain.
Not the entire sprawling value chain, at least not immediately for everyone. Specifically focusing on partners and borrowers, over 500 employees first. This means that companies who are direct partners or borrowers will need to actively identify their own ESG risks, establish governance around them, address material issues, and update their systems to track and report relevant ESG data to their financiers.
Okay, still significant, but more focused. And the fourth?
Finally, what they call graded green financing. The package formally recognizes transitional activities.
Activities that aren't fully green yet.
Exactly. These are activities or companies that are clearly progressing towards alignment with the EU taxonomy goals, even if they're not fully compliant yet. This is crucial for sectors like heavy industry or certain parts of the energy sector undergoing transformation.
So it provides funding for the transition itself.
Precisely. It opens up opportunities for banks and investors to use transition finance instruments with dynamic ESG KPIs linked to achieving specific milestones, potentially offering preferential terms for documented improvements. Again, the article stresses this requires very careful legal scrutiny to avoid greenwashing.
So this EU package, despite some controversy, is really pushing ESG into new tangible areas like contracts and demanding a more strategic adaptation from businesses. Why should you be tracking these specific European ESG developments, especially if you're outside Europe?
Because they influence where capital is going to flow globally. They change how businesses, especially those dealing with Europe, are going to be evaluated. They identify specific investment opportunities related to transition finance and ESG tech. And frankly, European regulations often set trends that have ripple effects worldwide. It just shows how sustainability is becoming deeply interwoven with business strategy, finance, and even legal frameworks everywhere.
The sources also touch on something they call the tree renaissance. That sounds quite poetic. What do they mean by that?
It's about viewing forests not just as environmental assets, which they are, but as potential vehicles for financial inclusion, specifically powered by fintech.
Financial inclusion through trees? How?
Well, they argue that traditional carbon markets often had limitations or were inaccessible to smaller landowners or individual investors. But fintech is now enabling the turning of trees themselves into what they describe as tradable assets.
Like owning a share in a tree.
Sort of, yeah. Particularly through projects involving tropical hardwood cultivation. They talk about using digital platforms, maybe blockchain for transparency, and innovative models to democratize investment, allowing for micro-investments in tree cultivation projects.
Interesting.
Elaine Romero's Forests to Fortune initiative is highlighted as an example of creating platforms for fractional ownership of trees, providing transparency, liquidity, and scalability, effectively linking environmental stewardship directly with economic empowerment for individuals, potentially in developing countries.
Fascinating intersection. Okay, moving towards the future landscape described in the magazine. The sources identify 2025 as looking like a defining year for stablecoins and digital currencies.
Yeah, they seem quite bullish on that time frame.
What makes 2025 so significant in their view?
They argue it's primarily driven by the maturation of legal and regulatory frameworks that are becoming clearer and more business-friendly. They specifically mention things like the U.S. Genius Act, the EU's comprehensive MiCA regulation coming into full effect, and Hong Kong's stablecoins bill. These frameworks provide guardrails and are expected to have broad implications for global banking and the integration of digital assets.
And are traditional financial platforms reacting to this shift? Are they getting involved?
They certainly seem to be evolving.
Yeah.
The article points to AirWallex as an example. It's a platform traditionally focused on cross-border payments,
Right.
which recently had a very significant $300 million Series F funding round, valuing them at $6.2 billion based on strong growth. Their founder is quoted talking about building a new foundation for the global economy, one that's fast, seamless, and built for scale, consciously contrasting it with older, legacy financial infrastructure.
So they're positioning themselves for this new world. Does the magazine see these traditional players in the new digital asset world converging? Or are they separate tracks?
They see the potential for convergence. The idea is that merging the world of fiat currency and cryptocurrencies, particularly stablecoins, could truly transform financial services.
Oh.
By improving the efficiency of traditional platforms and enabling faster, more cost-effective transactions globally. While that full convergence hasn't happened overnight, they believe the evolving regulatory environment for stablecoins is actively influencing how traditional platforms like AirWallex are approaching digital currencies across various use cases within the broader digital asset ecosystem.
So this intersection of traditional finance evolving and digital assets maturing, that sounds like an area for potential investment opportunities.
That's certainly the conclusion drawn from the sources. The evolving ecosystem, driven by clearer regulations and technological advancements, is seen as opening up a significant array of investment opportunities precisely at that intersection of fiat and crypto. They describe it as creating a richly diversified and robust era for financial services that can support agile and dynamic capital flow. The consistent advice, however, is unsurprisingly to stay incredibly informed and employ effective risk management in this rapidly changing space.
Makes sense. Finally, the magazine wraps up with some very practical insights on building for the future, specifically from the perspective of startups.
Yeah, drawing from someone named John Evans, who apparently has worked extensively with startups. He outlines what he sees as the 3 core competencies a startup really needs to succeed.
And those are?
Subject matter expertise, business knowledge, and technology usage. And he suggests there's a natural order to focusing on these in the early days.
What's that order he recommends?
He believes you need to get the subject matter expertise right first. Truly understand the problem you're solving and the industry you're in. Deep domain knowledge.
Okay, foundation first.
Then comes business knowledge, how you're actually going to build a go-to-market strategy, sell the product, and make money. And technology usage is often the last piece to fully build out internally. Unless the core innovation of your offering is the technology itself, like a deep tech startup. He notes this hierarchy impacts how you build your team, suggesting you might actually outsource the business and tech skills early on while focusing intensely on deep subject matter expertise internally.
He also talks about balancing speed, which is always critical for startups, right? Move fast.
Absolutely. But he adds some important nuance. He suggests dividing the early stage into 2 substages. The R&D MVP phase, where you're developing and testing the core product, and then the go-to-market phase, where you're actively selling and scaling. His key point is that you need to take sufficient time in that first R&D MVP substage to build a solid foundation.
What does that mean practically?
Doing in-depth market research, carefully planning your strategy, and crucially, rigorously testing your product. His phrase is, don't roll out and crash. He argues this foundational work is critical, even if it means going a bit slower initially than maybe the hype suggests.
But speed becomes essential later on.
Yes, precisely. The argument is, the more effort you put into that solid foundation stage, the faster and more effectively you can move in the go-to-market stage. Speed after launch is critical.
Why?
Especially if your company doesn't have a strong competitive moat or unique barrier to entry. It's necessary because of cash. Burned startups are constantly spending money and need to generate revenue fast. And fast revenue growth is key to raising external funding, which he notes is much more limited in the post-QE world compared to the easy money era before quantitative easing ended. Strong revenue growth is what really impresses investors today.
And speaking of investors, what's the long-term goal he points out for them? What do they ultimately want?
Well, ultimately, investors want an exit for their investment, usually either an IPO or, more commonly, an acquisition by a larger company.
Right.
And given the more difficult funding market post-QE, he argues that acquisition is now more likely an outcome for many tech companies, especially perhaps fintechs, that might offer a specific point solution, but not a full-service platform attractive for an IPO.
So if acquisition is a likely path, what's a key takeaway from his perspective for founders?
His crucial advice is, if you recognize that acquisition is a probable or even desired outcome, you should identify key strategic partners very early.
Partners who might eventually acquire you.
Potentially, yes. Or partners who operate in the same ecosystem. Building relationships and potentially generating revenue through partnerships with larger players can significantly accelerate your growth trajectory and, critically, provide multiple potential exit options down the line. This prevents you from being reliant on just one single partner or buyer when the time comes.
Makes sense. Build options early. So, strategic planning. A balanced approach to speed, focusing on a solid foundation, and identifying key partners early on are really key lessons for startups today. Why should you listening be keeping an eye on the digital asset space and these lessons from startups?
Well, they represent future investment opportunities, certainly. But more broadly, they are the drivers of innovation in finance and many other sectors. They show you where future services are likely to originate. And frankly, the lessons about business building, balancing foundational work with speed, strategic partnerships are valuable for anyone in business, not just founders running startups.
Wow, okay. We've covered so much ground in this deep dive, thanks to the insights packed into this issue of FinanceX magazine.
Yeah.
Really, from the foundational role of things like the LEI for entity identification and innovative ways to measure emissions like GHG nowcasting.
The data layer.
To completely new ways of delivering banking services that hold beyond banking theme and thinking strategically about structuring global teams with right shoring.
Yeah, the delivery models.
Then we hit the accelerating AI revolution, the crucial point about how we use technology, not just what tech.
The integration piece.
And dug into navigating the evolving ESG landscape, seeing how it's becoming contractual, requiring maybe those Nash moments of collaboration, the impact of EU regulations, even the tree renaissance.
Quite a range.
And we finished by keeping an eye on the future with stablecoins, digital assets, and drawing those practical lessons from startups building that future.
These sources really paint a vivid picture, don't they? It's a financial world undergoing rapid, interconnected transformation. You see it driven relentlessly by technology, a growing, unavoidable imperative for sustainability, and an increasing need for strategic partnerships and collaboration.
Yeah.
The consistent thread maybe seems to be the absolute need for adaptability and a clear-eyed, intelligent approach to data, to technology, and, crucially, to working effectively with others.
It really makes you think, in this era of just relentless change and constant information overload, where intelligence, as the article claims, seems to be doubling every 6 months, and financial services are embedding themselves everywhere. How does one truly build resilience and find opportunity? Is it about trying to become an expert in just one incredibly narrow area anymore? Or is it more like John Nash, developing a mind that can see the connections across different fields, the patterns hidden in the data, the strategic advantages in collaboration, the cooperative strategies needed for, well, collective benefit?
That really raises an important question as we wrap up. In this increasingly interconnected and rapidly changing world, can you afford not to adopt that kind of strategic systems-level thinking?
Something to definitely mull over. Thanks for joining us for this deep dive.